So what should you choose? I mean, this is a unique time in history where literally you have all sorts of options where you can put your money and earn a good guaranteed interest rate. Think about it. There's high yield savings accounts, there's those CDs you got out there, you got fixed annuities, and as I always say, you got those specially designed and engineered whole lives. But I've been hearing this a lot on calls about how people are starting to think that the new savings account option, the place that we all know so well, the traditional bank where they can put their money, and some banks, the high yield savings, are paying almost 5 or even a little over 5%. And they think the parade is never gonna end. They found the holy grail, the FDIC grail, protected, secured, guaranteed. I can't lose. I'm just gonna put all my money in the bank in that high yield savings and those specially designed whole lives. Well, I don't need that life insurance thing. That's what we're gonna talk about today. The security or false sense of security that so many people, maybe even some of you, are feeling because you've got all sorts of options and you think it never is going to end. My name's Chris Naugle. This is What Now? What's next for your savings account? We'll get right into that. I talk about analytical folks all the time, and I had an engineer on the phone with one of my money mentors recently, and the discussion went a little bit like this. Try to follow along. He was looking at the infinite banking concept, which, make no two ways about it, is a process that allows you to take back the banking functions in your life. You notice how I didn't say anything about a product. But this engineer was hyper-focused on the product, the whole life, the specially designed and engineered whole life. That's right, that's all he wanted to talk about. He didn't care about the process. He's like, the whole life, the whole life, the whole life, the interest rate, the interest rate, the interest rate, the math, the math, the math. Listen, engineers, no disrespect if you're an engineer, but they want everything to fit in a little square box that looks just like this, folks. Everything should fit in that box. And if it just happens to fit a little bit outside that box, it doesn't, it's bad, it's bad. And what this little box for him is that he was getting a good interest rate on a high yield savings account. I think he was getting somewhere around 5.2%. And he ran all the math. I can't even fathom how much time he spent on this. It had to have been like literally 8 hours. He had all the math. He had run all the math on his high yield savings, and he did it over a long period of time, 5, 10 years. And then he ran it side by side, good for him, against that specially designed and engineered whole life insurance policy that paid a guaranteed interest rate plus dividends in a tax-free environment. Now, as he was comparing these, he made a strong argument that he would make more money at any time frame in that high yield savings account. What do you think? What do you think won? The specially designed whole life or the high yield savings account over a long period of time? Did you say the high yield savings account? Because you'd be right. So this engineer had engineered the perfect square little box in his mind that everything remained equal with his high yield savings account. I felt awful, when I reviewed this, and I didn't even do the call with the guy because I just couldn't. Like sometimes, the truth, but it's just like, should I tell him and burst his bubble and upset him? I mean, come on, he's having such a good time making these spreadsheets, spending days figuring out that he is right and him alone. He has proved the Chris Naugle and all the other infinite banking people wrong, because now a savings account is a much better place to park your money and earn interest over any period of time. Now, here's what I was thinking. I'm thinking to myself, you know what? Has anyone ever told him that, just a few short years ago, those high yield savings accounts paid how much? Close to zero. And how long did they pay close to zero? Years. I mean, they were paying between 0 and 1% for an extended period of time. But then all of a sudden the Fed creates this money printing madness, which leads to transitory inflation. There was nothing transitory accusatory about it. But then they said, oh yes, we do have an inflation problem that was about 9%, and they were going to slay the dragon by raising interest rates and controlling monetary policy. That's in their realm, that's their lane, that's what they do. So they started raising rates really fast, from close to 0 up to today's interest rates, which are 5.2 to 5.5. Yes, it's a range. So hence, bank accounts, high yield bank accounts, are paying 5% in some cases. Why? Well, because you could buy short-term Treasury bonds that then pay more than what they're giving customers like this engineer on their high yield savings. Anyway, I went a little too far on that. Nonetheless, what I'm trying to say and what this engineer failed to realize, which just blows my mind. I mean, engineers are so smart. Literally years and years and years of schooling to teach them how to make everything fit in a square box. But that's what they do. That's right. You don't want to drive across a bridge that was engineered outside of the square box of like the thresholds that makes that bridge support the weight so it doesn't just fall down. Yeah, you wouldn't want that. So it does make sense. But you see, what he had wrong is the fact that he was assuming that high yield savings accounts, his high yield savings account, would continue to pay the same interest rate. And he was assuming that his high yield savings account was tax-free. Because remember, the specially designed and engineered whole life is very different than a high yielding savings for two, maybe many more reasons, but let's just focus on the two that the engineer wanted to focus on: interest rate, interest rate, interest rate, and interest rates. But the savings account has an interest rate today that's, yes, very, very appealing, but tomorrow it might not. Matter of fact, Jerome Powell came on not long ago, opened the front door and said, hey, we might drop rates 3 times in 2024. Now, they didn't drop them this last time, and they hinted that they probably won't drop them in the next Fed meeting, but they still left the door open. It's kind of like, hey, I'm going to leave the door open a little bit. If you want to come in, you can, but anyway. Now, let's go over to that specially designed and engineered whole life where the engineer was trying to slay and prove us wrong that the specially designed whole life will never beat a savings account. I want to make mention that that specially designed whole life pays a guaranteed interest rate for how long? Your life. Contractually guaranteed to never change for the entire period you are alive. Oh, and then when you graduate, nice way of saying when you die, they send a tax-free death benefit to your beneficiary, your spouse, your kids, whoever you want. So this engineer clearly didn't care much about his kids or his family, or he just had term insurance, which would be very appropriate. Oh, I'm doing another video to explain why term insurance is single-handedly the most expensive life insurance on earth, but that's not for today. But anyway, back to the thing. So now we're comparing a taxed, your savings account, you got to pay tax on it every single year. That's right, you get a 1099 for that interest you earn, and he's earning over 5%, so he's going to get a nice hefty 1099 for the interest. The specially designed whole life? Nope. The internal buildup of that cash value that is built by two things. Number one, an annual dividend, and number two, a contractually guaranteed interest rate. There's no tax on that as long as it's built properly, which we know how to do. Check out the video in the bio right now, shameless plug. There's a video that explains the infinite banking concept and shows you two scenarios. You want to learn how to get all the money back for all the cars you're ever going to buy, drive, and own? Watch the video. You want to learn how to pay off all your debt without working harder, longer, or having to take on any risk? Watch the video and book a call. There's a link where you can schedule a call with our team. Anyway, back to this square box, this engineer, and which one's better. So, yes, the savings account beat the whole life because the whole life has all those fees, and fees, right? Yep, cost of insurance, policy service fee, and my God, I got to get a commission, right? But he failed to realize the long-term play wasn't in the interest rates. The long-term play was the uninterrupted compounding interest where this engineer could have put money in the whole life, taken the money out, went out, made money a second time, made a spread on his money, even after paying the insurance company that interest they charge on those loans. You're still making more because your money never left your account and still continues to compound. Try that in your high yield savings account, Mr. Engineer. Try to put your money in that high yield savings, then take the money out of the high yield savings, and then invest it wherever you want, where it's going to make more. Does the bank, the high yield savings, still pay you interest on the money when you took it out to go invest it at a higher interest rate? No. When you took the money out of the high yield savings, the bank of course stopped paying you interest. So you're still only making money once. But over here in the specially designed whole life, you're making money twice. But he failed to realize that. He also failed to realize that the savings account likely in the future will pay a lower interest rate, probably significantly lower if the Fed drops rates, which they will, because we'll be in a recession, and that's what they always do, is drop rates. So failed to realize that. Oh, and also your high yield savings interest, yes, that really good interest, which is backed by T-bills. Why didn't he just buy the T-bills? That's another discussion too. Sorry, I'm going down these rabbit holes. That's all going to be taxed. So now you'd have to figure out your tax rate, you'd have to figure out what impact that has, and you'd have to figure out your after-tax effective yield or interest rate that you're earning on the savings account. We're over in the specially designed whole life. It is what it is because it's tax-free. Do you get my point? I know that was a long story down many, many rabbit holes, but let's just take a pause real quick because I know you need to reset, because then what we're going to do is we're going to go into CDs, money markets, high yield savings accounts, and yes, those stupid specially designed whole lives. But before we do that, I need you to hook a brother up. And I need you to click that subscribe button. Hit the subscribe button, and right above there's a little bell. Smash that bell so that you're notified every single time that you, or actually every time I put a new video out. You're not putting new videos out. But anyway, I'm going to just kind of give a little memory to the Buffalo Bills this year. Yes, we're not in the Super Bowl. I think it's the 49ers and the Chiefs. But you know what? Hey, Kirkpatrick, how did you miss that? Come on, man. What the? I put that right in your hands. All right. Anyway, let's get back into it. So, like I said, there's all sorts of really cool options out there for you to take your money and get that money making a good interest rate. I mean, the Fed's blessed us with these high interest rates. So therefore, they have also, I don't even know who's part of the Fed. I know Satan sits on the board of directors, and then you got that Jerome Powell guy. And anyway, it's not important. It's not important at all. It is not a government institution, and it is a private institution. So they keep raising rates, and they've also vowed that they're going to keep them higher for longer. So therefore, you can make a great return on some CDs. So what are CDs? And let's compare CDs to that engineer's high yield savings account. Now, this is an important thing. A high yield savings and a CD, technically you could buy both of them from the same bank or credit union if you found one. Now, high yield savings accounts, like the one that the engineer was talking about, typically have a couple downsides. Number one, if you put more than $250,000 in either one, the CD or the high yield savings, you are above the FDIC guaranteed amount, which means your money is no longer guaranteed. Now, I know you think that the Fed's just going to step in every time and be like, oh, you had $1 million in there? No problem. Here you go. Here's your $1 million back. But I'm telling you, that's going to stop. So $250,000 minimum. For some of you, you're like, dude, it's okay. 250 is fine by me. Great. But the other thing that is kind of restrictive, on the high yield savings accounts, there are a lot of banks that do not allow you to just take that money out anytime. Sometimes you can only take X amount of withdrawals at a time. Some of them have restrictions. You got to look at the fine print. So CDs, on the other hand, you just put money in one time. You cannot make any more deposits because the rates are always changing. So if you lock in a 3 or a 5-year CD, you might get 5.35% today. I mean, we're in February 2024. Rates are still high, but that money, that's it. If you get some new money, you get a new bonus, you sell your car, you sell your house, and you want to do something with that, you got to buy a new CD at whatever the prevailing rate is at that time. Not only that, CDs, once the money goes in, how many times do I got to tell you, folks, you're giving up control of your money. That's right. Even in the bank, you're giving up control. You put money in that CD, and if it's a 3-year CD, that money's got to stay there for 3 years. Chris, I don't care about that. I'm saving up for a car, so that's the reason I'm doing it. Or I'm saving up for a house, and I don't plan on buying a car or a house for 3 years. Great. But don't take that money out sooner, because if you do, there are early withdrawal penalties. Now, those penalties vary, but usually it's your interest that you've earned or a portion of the interest you've earned based on the amount of time you've had that CD. So money goes in, Bank gets to use that money. Oh, and then you'll probably go back to the same bank and take a car loan because you didn't save enough. You'll take a car loan out from the bank. So the bank paid you 5.35 on the CD and they charge you 8% for the car loan. Who's winning? It ain't you. Anyway, the bank's winning. They make a spread between 5.35 and whatever they charge you for the car loan. Make no two ways about it. You're not getting a loan less than what a CD rate is, and you're definitely not getting a loan less than that high yield savings. So the bank is in control of your money and the bank is winning. But hey, everybody's gonna make an excuse to make this make sense to do a CD or a high yield savings, but also make a point to remember that high yield savings, although the rates are great today, tomorrow, next month, halfway through 2024, the end of 2024, chances are that rate will be a lot less. That's right. You'll go from 5 to 4 to 3, and there ain't you can do about it because you ain't in control of your money. The bank is. Or should I say the Fed is actually, yeah, because the Fed controls the banks control your money. Yeah, got it. Write that down. Fed controls banks. Got it, okay? Banks control my money, and banks control my ability to buy expensive things with loans. Did you write all that down? I got my notes. See? Always learning. Now, we can go one other place, and let's, okay? Money markets. You know, you got that brokerage account, you got that high yielding money market. The same rules apply for your money market as they do your high yield savings. However, you can have a money market inside of a Roth IRA, which means now it's growing tax deferred, and when you take the money out, it's tax free. So none of those pesky taxes. Oh, also, you could have a money market inside of a brokerage account, inside of an IRA, inside of a Roth IRA, inside of a 401k. So you can see it's a little bit more universal, but they're identical. Do you know why? Money markets, high yield savings are all based on one single solitary thing. How much are Treasury bills paying? That's right. Because what backs a CD, what backs a money market in most cases, and what backs your high yield savings account? I mean, banks got to put their money somewhere where they're making a higher interest rate than what they're giving you on those money markets or high interest savings or CDs, right? What is it? T-bills. That's right, Treasury bonds and Treasury bills issued by the full faith and credit of the United States of America. Got it? So if the bank's paying you 5% on your CD, on your money market, on your high yield savings, riddle me this. How much are they making on their T-bills? Well, go into this. I know it's a little known secret, so I'm gonna let you in on it. It's called Google. Yeah, it's Google. And then what I want you to do is I just want you to type in Treasury bill yields. Okay, that's it. Treasury bill yields. Right there. You can see it down at the bottom. All right, so here we go. A 6-month Treasury bill pays 5.25. Now, let me do one more thing. How much do 6-month CDs pay? Now watch this and you'll learn. Let's see, 6-month CDs, well, we got a whole bunch of choices here, but the national average CD rate on a 6-month term, 5 days old, this is right, 1.51% APY. Hold on, the best CD rates for 6-month terms are 5.75, available to new members of Andrews Federal Credit Union, so that's pretty good. But let's just go with the average CD rate for 6-month terms. That was an ad for that credit union, that's why I stopped at that. So remember, 1.51 versus how much can they make on that? 5.25. Subtract the difference, you have the spread that the bank makes. Okay, 1-year CDs, okay, if you went to a 1-year CD, you can buy a Treasury bill right now for 4.82, a 2-year at 4.37, and a 3-year at 4.14. So what I'm trying to explain is depending on when banks buy these T-bills, they'll use that interest rate to support the amount they're going to pay you. And usually they're going to make a small little spread, about 1/4%, maybe 0.5%, maybe more. But that's how they do it. That's how they do it with CDs. That's how they do it with money markets. That's how they do it with high yield savings, except for high yield savings floats with the wind. Today it's 5, tomorrow it's 4.85, the next day it's 4.9, it's gonna float. That's all you need to know. CDs at least lock your rate in for the term because they're locking in a T-bill for a specific term. I'm just trying to get you to understand what's going on and how they're doing what they're doing and why you, if you're thinking that this parade's never gonna end like that engineer, why you're gonna be really upset. Because when your CD matures, there is a very strong probability it will mature and you'll go to buy another one and it will be a lower interest rate. There's a very strong probability that your money market will be worth or paying you less, not worth less, but paying you less interest in 6 months to a year from now than it is today. Same thing with your high yield savings, except for your high yield savings will float kind of just like, when you fart in the wind, right? You smell it right in the beginning, but then after that, it's gone. Well, that's kind of like the savings accounts. Like you get excited about the rate today, but then all of a sudden the wind blows and it's gone. I mean, better for farts than it is for interest rates, but I just wanted to put the comparison there so you kind of know what I'm trying to explain. Anyway, this is where I make the argument. This is where I make the argument that the specially designed and engineered whole life always is going to trump any of those things I said, because let's just compare. What are the reasons why? Well, the reasons why are you get a contractually guaranteed interest rate that goes your entire life and never changes. And how much is that interest rate? It depends on the insurance company, but anywhere from the lowest of 2% up to 3.25% lock, stock, and barrel. But then we add a dividend. And also dividends have been going up. Why? Well, because insurance companies, like banks, like all those other institutions, they go out and they buy Treasury bonds, not bills, mostly bonds. And they lock those suckers in for 30 years so that they can guarantee you an interest rate for how long? Your whole life. Yeah, so they're just locking in high interest rates left, right, and center and promising you through a contractual guarantee they'll pay you that guaranteed interest rate. And dividends are been going up because the same reason. Profitability. If insurance companies buy a 30-year bond that is a higher interest rate and it's locked in for 30 years, do you think that's going to help their profitability? Well, yeah. Look at their balance sheets. How much money do they got in Treasury bills? A lot. Like tens, sometimes more, billions. I don't know. There's a lot of zeros, and sometimes I miss up and think it's 100 millions or billions, or it's a lot of money. So that's one reason. The second reason, well, the specially designed and engineered whole life allows those dividends and that interest to grow tax-free. As long as it's designed within the MEC 7 pay guidelines, that's tax-free. And then what else? Well, that specially designed and engineered whole life is protected against judgments and liens. Your CD, your bank account, your money market, are those protected against judgments and liens? In 99.99% of the time, nope, that shit's low-hanging fruit. You ever walk through an orchard and you're really hungry? What apple are you gonna go for? You're gonna go for the one at the very tippity top of the apple tree, or are you just gonna kind of sit there and, oh, look at this one, that one's good. You just pluck it down, rub it on the shirt a couple times, take a bite? Always the low-hanging fruit. Well, attorneys are no different. They're gonna go for the low-hanging fruit. And Mr. Engineer, it's that high yield savings account, buddy. Oh yeah, they're not going after that specially designed whole life. Why? Because they're protected against judgments and liens in most states. And even the states where they're not, they're still more protected than your savings account. But what else? Well, one of the two certains in life, which we covered one, which is taxes, but the second one is death. You're going to die. I'm sorry, I know you don't like to hear that, but when you do, wouldn't you like to leave your family in a better place? I didn't ask that engineer that, but Mr. Engineer, do you want your family to be left in a better place the day you graduate? Because that savings account, that money market, that CD, they're not going to leave your family in a better place. Nope. Matter of fact, all of those accounts, unless they're in an IRA, are not protected at all, and they all become part of your probatable estate. Probate. Look it up. Probate. Specially designed whole life, that death benefit, yep, bypasses probate, goes right around it. Yep, goes direct to your beneficiary instantly. Where your savings, your high yield savings, CD or money market, well, they get tied up in probate. You got attorneys and all that stuff. Yeah, if you haven't gone through probate with a family member, try it. and you'll come back saying, nope, that wasn't what I wanted. So you see, when we're comparing these, it becomes, even just comparing product for product, a very difficult thing to say that the specially designed whole life doesn't give the rest of these false hope, false sense of security, machines, vehicles, products like CDs and money markets. It doesn't really hold up. But then when you add in the main thing that we teach, the main thing I show every day, I know we talk product today, but the process of the infinite banking concepts, which is a process of taking back the banking functions in your life, there is no other vehicle that can compete with the specially designed whole life. Not one, not IULs, definitely not VULs, oh, not term insurance, not even close, not the high yield savings, not the money markets, not the CDs, not even T-bills, because none of them allow you to put money into them, then take the money out like you can the whole life. You can take a loan from your whole life, which is you taking the insurance company's money from their general account, subtracting it from your death benefit, and you get to use it while you're living, while your money stays in the account, 100% of it. So if you had 100 grand in cash value and you took 90 grand out, how much is left in cash value? 100 grand. If you had 100 grand in a high yield savings account and you took 90 grand, how much is left in the savings? 10 grand. How much are you earning interest on in the savings? 10 grand. How much are you earning interest on in the whole life? 100 grand. Do you see what I'm saying? Uninterrupted compounding interest. You know, Albert Einstein loves this stuff. He said compounding interest is the eighth wonder of the world, the most powerful thing in the universe. And he then goes on to say those that understand it, those infinite banking folks, yeah, they get it. Those that understand it earn it. And those that don't, those high yield savings accounts, CDs, money markets, yeah, they pay it. Because they put their money in the CD, then they realize they can't get the money out. They find a really nice car they want to buy before their CD's up. And what do? They take a loan from the bank and they say, it's okay, honey, we're making 5% on that CD. We'll take the loan from the bank at 7 or 8%. We're covering most of it just with interest. Silly rabbit, you forgot about the taxes. Anyway, I love this stuff. And I hope I shed some light, maybe got you to laugh a little bit, maybe got you to cry a little bit because you just bought a CD and you're like, damn it, I told you don't do the CD. That Chris guy was right and he just proved it. It's okay. We'll get you next time. The CD will mature. Give me a call when it does and we'll get you started in one of those specially designed whole lives. And we'll actually teach you that it's not about the product, it's about the process that's going to make you wealthy and keep you wealthy. With that being said, folks, go out there and enjoy the day. Don't go out and buy a CD. Don't think that savings accounts rates are going to stay forever. It's all going to go where? Down like the Titanic. My name's Chris Naugle. This has been another episode of What Now? What's next for your bank account? I don't know. But I also should tell you right now, check out this video. I always forget what way it goes, so I'm just going to start doing this. Check out this video right here and learn how you can get all the money back for every Porsche or dream car that you will ever buy, drive, and own. It's a really fun video. Check it out. We'll see you next time.